Welcome everyone to the latest in our series of The Box. And in fact, this is the last for the calendar year. I'm Ben Hardiman. I'm joined today by Liam Burnett. We are both partners in our insurance disputes practice. And today we're going to be talking about the implications of COVID-19 on claims against insurance brokers. The focus of our webinar today is going to be on claims brought by SME businesses in respect of business interruption insurance in the context of the FCA test case and the non-damage BI extensions for disease and prevention of access, which I'm sure the vast majority of those on the webinar today will have heard about and will have seen some information about. Just to start with, a couple of points of housekeeping. Firstly, we are recording today. The recording will be available afterwards. And secondly, there will be time for questions at the end, hopefully a little bit. Please feel free to post them in the chat box and we will do our best to answer as many as we can in the time available. So I thought we'd start with what is currently happening. Liam and I have both been working with brokers extensively over the last 18 months or so since the pandemic began. We provide a helpline to one of the major insurers in the market, and that helpline is focused on COVID-related issues that are affecting brokers. Liam and I, along with Neil Franklin and James Thompson, have spoken with numerous brokers over that period of the pandemic, and I think we're really well positioned to speak on this subject as a result. We are seeing some claims, but not really in any significant volume, and I thought it might help just to address why that is. Firstly, alongside managing the groundbreaking FCA test case, which ended up with the landmark Supreme Court judgment in January, the courts have set up a specialist list to handle COVID BI claims. Now that deals with claims against insurers, but it will also deal with any claims which are brought against brokers and enter litigation. It's managed by the two judges who gave the High Court judgment. Now, as part of that, the specialist list is dealing with a number of claims between some fairly prominent policyholders and their insurers, some of which are already listed to go to trial in 2022. I don't have time really to go into any detail. Just to give you an idea, Park Dean Resorts against Axis is a £70-odd million claim made by the operator of a holiday parks business. The main issue, as I understand it, is whether tail losses fall within the scope of cover. So that's where losses are incurred after the indemnity period, but which are said to be caused by the original prevention of access. There's also a claim relating to damages for late payment under the Insurance Act. That's listed for trial in June next year. Corbin and King and AXA, a claim by the operators of the Ivy group of restaurants, principally focused on the interpretation of non-damage denial of access clauses. It will also deal with inner limits of indemnity. That, again, due to go to court to trial May 22. Stonegate and Amlin, a very big one, 800 million said to be at stake on this. This is a claim by the operators of the Slug and Lettuce. This one really is focused on the number of occurrences and the aggregation of losses. And just finally, last week, the press was reporting a £100 million claim commenced by Greggs against Zurich. Now, I've not actually seen any of the pleadings on this one, but it's going to be interesting potentially, given that at least some Zurich wordings were found not to respond by the High Court, and those findings were not appealed. I think what we can all say is not in dispute is that £100 million is a very significant number of sausage rolls. Now, I mention this just by way of background because I think it shows that despite the good intentions of the FCA test case, the Supreme Court hasn't addressed all of the issues which have affected policyholders because it simply couldn't. And I think that while litigation against insurers is ongoing, particularly against some of these big headline issues, that may well delay the onset of litigation against brokers. What we want to do today is to address how claims may be presented against brokers and the arguments which are available to defend them. And for that, really, we have to go back to basics. Any policyholder is going to have to establish the building blocks of any professional negligence claim. The broker has to owe a duty, it has to breach that duty, and that breach has to cause a loss. What we're not going to touch on today is the quantification of loss, because that really is another topic of its own. So just starting with the scope of the broker's duty, the basic duty on a broker in this context is to identify its client's demands and needs. That's enshrined in ICOBS paragraph 5.2, and having done that, to give advice. Now, a broker's obligation in contract and in tort is to exercise reasonable skill and care. That will be assessed by reference to the standard of the reasonably competent broker. And I think that's going to raise some interesting questions. Was the pandemic foreseeable? Was it an insurable risk? And did a reasonably competent broker owe duties to its clients to advise about those issues? If so, should brokers have advised clients that certain, but not all, non-damage BI extensions, so the disease and the prevention of access wordings that we're talking about, may respond to pandemic losses in the way that the Supreme Court has now determined? Or perhaps even should a reasonably competent broker advise their clients to consider locating and purchasing pandemic-specific cover, assuming that existed? Now, the starting point on all of this, I think, is that brokers, insurers, and even the FCA who brought the test case all accept that the policies the Supreme Court was asked to consider were never actually intended to provide pandemic cover. The reason they do provide cover is because the manner in which they were drafted and the way in which the Supreme Court has interpreted those wordings. Now, having defined the scope of the duty, the next stage is a bit more fact specific. Was the risk of a pandemic a necessary part of a particular policyholder's demands and needs? And it seems to me in the vast majority of cases, and there's always going to be outliers, particularly at the SME level, some specific circumstances or perhaps a specific factual background is going to have been necessary for a broker to have identified the need to obtain cover for BI losses which arise out of a pandemic. Practically, influenza-based pandemics are rare. They are right at the edge of the spectrum of risk. It requires an epidemic which becomes so widespread that it affects a whole region, a continent, or even the entire planet, which is obviously what we've ultimately experienced. But we all know about it now. Whether we knew about it 2 or 3 years ago is a different question. And the World Health Organization has identified only 3 pandemics in the last century. There was the SARS outbreak in 2002, 2004, but that's said to have only affected 10,000 people worldwide. And I think officially it is classed as an epidemic rather than a pandemic. But ultimately it had very little impact on the majority of SME businesses in the UK. So if or when claims are brought, we expect there's going to be a lot of argument around whether or not it fell within the scope of a broker's duty to advise SME businesses on the types of issues that ultimately the Supreme Court had to consider. Now, having established the duty, we then move on to whether that duty is breached. And I just repeat that what we're looking at today is the non-damage BI losses caused by COVID. It is conceivable that certain types of policy, perhaps in the travel industry, may well have required consideration of the risk of pandemic, or at least the risk of disease leading to cancellation of events. But that's not what we're talking about on this webinar. So the focus here is the broker advising a business about business interruption. Now, brokers have repeatedly said to me that no one knew a pandemic was covered. So brokers were probably not advising SME clients about the need for cover. And certainly it wasn't being obtained intentionally. And I think there's 2 ways to view this. On the one hand, there's authority in a broker context that if the majority of skillful and experienced brokers would have come to the same conclusion, then it would not be negligent to act in the same manner. And that really is the essence of a reasonably competent test. On the other hand, I think claimants will say that the court has sometimes determined the standard it thinks that members of a profession ought to achieve, not necessarily what the profession was doing. The fact that everyone did the same thing doesn't make it necessarily the right thing to have done. Whichever way that argument goes, though, it will still be necessary to establish that there was something particular about this business that necessitated the advice being given and the policy being obtained. There will be outliers, and I'll come on to the one in a moment, but the important thing is that claimants can't rely on hindsight. When you remove hindsight from the equation, businesses were not factoring in the risk of pandemic to their planning, and brokers may well have received criticism for trying to sell something that simply wasn't being perceived as a risk, or therefore that cover was needed. I've asked, what about Wimbledon? It has been fairly widely reported that the All England Lawn Tennis Club obtained cover for pandemics, and that's paid out something like £175 million to Wimbledon. Now, is it true that because Wimbledon was covered, it shows that insurers and brokers were dealing with this issue? Well, I think this goes back to the assessment of the demands and needs of a certain type of business. Wimbledon isn't unique, but it's certainly at the end of a spectrum of businesses who have very specific needs. It's very different to most of the businesses that the majority of brokers will have been advising. The other aspect to this question is causation. Liam's going to delve into this in a moment, but in this context, it's been reported that the premium over the last 20 years that Wimbledon's been paying is something like £1.5 million per year. And I think in that context, it's going to be a major challenge for any SME business to establish that they would have been prepared to pay anything like that sort of premium. So I'll hand over to Liam now to address the final point on the slide, and then he will also move on to causation.
Thanks, Ben. So just a final point here before I move on to causation is the argument that, as we now know, there were policies that were available at the time which do respond to pandemic BI losses. However, that's only because of a decision that the Supreme Court reached after a forensic analysis of the meaning of particular words in a contract. And it's really important to bear in mind that insurers never intended to provide this cover, and it only exists due to slack wording which developed over time. And as far as we understand, it was aimed at providing limited cover for localized events. And it's taken the most specialist insurance judge in the High Court and several Supreme Court judges, together with a significant proportion of the leading insurance counsel and lawyers in the country, to pore over the wordings of these contracts and ascribe different meanings to words in different contexts, and then eventually reach a decision. So I think against that background, it's very difficult as an argument for a policyholder to raise now that a broker should have foreseen that some wordings might respond to what was already perceived to be a very remote risk, whereas other policies would not. And then on the back of that analysis, to recommend a particular policy to the client to meet this very scenario that we find ourselves in. It's also crucial to keep in mind that non-damage BI extensions were only one aspect and potentially a very small part of the policyholder's overall cover. And there are any number of reasons why a non-test case policy may have been more appropriate, irrespective of the non-damage add-on clauses that the Supreme Court had to consider. And we've seen several examples of this in practice, where a broker has acted methodically in establishing its client's demands and needs, and finds a much better and far more suitable policy for its client. The client then purchases that policy on advice, which was the right thing for that business to do, but it now turns out, following the Supreme Court's decision, that they moved away from a policy that would have provided some BI cover to one that doesn't. Now, we really think that policyholders are going to struggle to make out this line of argument when all things are considered if claims are brought. And final point to touch on, I think it's also reasonable for a broker to argue that it has a duty to to obtain a policy for its clients which does not create the risk of unnecessary litigation. And just think about it, that's exactly what purchasing a policy with one of the test case insurers has done. Lots of interesting arguments, I think, will arise there. Just now moving on to causation. So even if breach is established, the policyholder must still establish causation. The test is no different from in any other broker claim. And in that connection, the claimant can't rely on hindsight when it seeks to establish that what it would have done but for receiving the allegedly negligent advice. So the first question is, was the cover available? And as Ben has said, we think it's difficult for a policyholder to argue that they should have been advised to purchase one of the test case policies that we now know responds. And we say that because those policies, and our understanding of the market at the time, is that there was very little, if any, pandemic-specific cover available. I think it's also fair to say that there will be some fact-specific issues here too. So, for example, a policyholder with a policyholder incepting or renewing in mid-March 2019, just before lockdown, is going to find it extremely challenging to establish that any markets existed at that point in time. And as one broker said to us under the helpline, you can't buy a policy for your house when it's already on fire. But if cover was available, then it will be necessary to consider if the insurer in question would have agreed to write the risk for that particular client. Many products are written via schemes. So just because one business was able to buy a policy that has paid out doesn't mean that a different business in another sector could have bought the same policy. And it might be that expert evidence will become necessary to establish the availability of cover for that particular company. Next, the question of what a policy would have cost is inherently linked to the question as to whether a policy holder would have purchased that insurance cover. The policyholder here has got to prove on the balance of probabilities what they would have done, which policy they would have bought, and that must be established without the benefit of hindsight. So as Ben mentioned earlier, rumours are that Wimbledon and the event paid a 7-figure premium annually. Further, the market reports that we've been able to obtain suggest that even where specific pandemic cover existed, that cover simply was not purchased. So as Ben mentioned, we think that Wimbledon is a real outlier, and we don't think that kind of issue is going to rise for SME businesses. So I think it's very difficult for a policyholder to prove that they would have bought that cover if it was available and if they'd been advised. But when we come to analyse this question in detail in the context of claims, we will inevitably have to look at the demands and the needs of the business and what its main drivers were at the time, just before cover was incepted. So what were the main risks that it was motivated to protect and insure against? And is it really credible for the claimant to now contend that it would have been persuaded to purchase one of the responsive test case policies before COVID ever existed or was known about? Now, I mentioned payouts simply for completeness, because whether insurer would pay a claim will be specific to the facts of any case. But even if a policy could have been purchased, there's no guarantee that it would pay out as the claimant might suggest when it brings a claim in its letter of claim. So, for example, even if the court to accept that a test case policy was the appropriate non-negligent policy that should have been purchased, the majority of these policies were all subject to inner limits, which restricted the amount of cover available. And the inner limits often applied to limit the amount of indemnity available, often to a very low 5-figure sum, around £50,000 in most policies that we've seen, or perhaps the cover was provided on a time-limited basis. So losses suffered during, say, a 3-month window might be recoverable. Now, simply because the company had purchased general BI cover over, let's say, a 24-month indemnity period, doesn't mean that they would be entitled to receive sums over that same 24-month period under the non-damage extension. Wider considerations will also exist about averaging and perhaps failure to comply with policy terms. And before we tie this up and draw to a conclusion, I just want to touch on expert evidence. Ben mentioned it earlier in looking at the scope of duty, but in many broker claims, courts have sometimes taken the view that they don't need expert evidence to assess the practices of a reasonably competent broker. However, we're unsure as to whether the court will take that approach regarding the impact of the pandemic. I don't think we can simply assume that brokers were or were not providing advice about pandemics and or what the reasonably competent insurance broker ought to have advised their clients. So I think expert input is going to be required there, looking at the scope of duty and whether that's been breached. It will almost certainly be required when looking at causation. So what products were available to which businesses and at what cost. And finally, whilst we're not looking at loss as part of this discussion today, the calculation of what losses have actually been suffered is complicated and again is likely to require input from an expert. So to conclude this discussion, In most cases, when clients don't have cover that they expect to have had, the broker is directly in the firing line. Those are the claims that we deal with on a daily basis. However, because of the issues that we've covered and considered today, we think that it'll be very difficult for policyholders who've not received an insurance payout to establish that they should have had cover for pandemic losses. And for that reason, we think that brokers are unlikely to be in the firing line for claims, but for the existence of exceptional circumstances where there might be outliers. Now, whilst that does not necessarily mean that claims will not be brought, because even bad claims can be pursued, we think that generally it will be very difficult for those claims to succeed. So that's all from us. Thank you very much for listening. I'm now going to hand over to Harriet Strevens for any questions that you might have.
Thank you very much, Liam. We do have a couple, but we're slightly running out of time, so I'll be relatively brief. To either one of you, Ben, perhaps in the first instance, you say that you've seen claims, but are you able to give us any insight as to what policyholders are actually arguing?
Yeah, thanks, Harriet. I think the most common complaint we've seen is that a policy was obtained, either that it doesn't contain a non-damage BI extension at all, so there is no cover, or alternatively that it does contain a non-damage BI cover, but that policy doesn't actually give cover. One example of this would be the Travellers and Rockcliffe Hall case, so the closed list of diseases, where the policy specifies the type of disease which it is prepared to cover. It'll often say cholera, chickenpox, rabies, etc. And since COVID-19 was not known about until it occurred, it's never been specified by insurers. So that's one of the areas where complaints are being raised. I think for the reasons we've talked about today, I think they are difficult claims to make out.
Thank you, Ben. Liam, do you have anything to add to that?
Only just an extension of the point I made earlier. So we are seeing complaints or claims where the policy holder has got a policy that responds in like the Supreme Court's decision, but they then contend that the amount that's paid out is insufficient. Now, the reality is that these non-damage extensions were included in policies as a matter of course. They weren't negotiable, and they just had inner limits, either inner limit of indemnity or for a short period. So, and that's because insurers' intention was that these clauses should only provide relatively narrow cover for localized events and not pandemic losses. But it might be an issue that this may require expert input as to whether wider cover was available if claims are brought.
Thank you both very much indeed. Well, in keeping with our aims to finish on time, it's now 11:23, so I'll reserve the questions left over for you to deal with by email if you can, and pass the baton back to you, Ben.
Yeah, thank you, Harriet. So just feedback. This is the last in our box webinar for 2021. Keep your eyes open for some exciting new topics in the new year. Feel free via the feedback to give us some ideas on what you would like to hear, and we'll do our best to talk about them. We do have our cover talk and breaking ground webinars still ongoing, so if you do need a webinar fix before Christmas, there are still some options available. Otherwise, thank you for coming today, and we will speak to you via the box in the new year. Thank you.
Thank you.